The financial world is buzzing with a prediction that sounds like pure fantasy. Silver soaring to $150 an ounce this year. After a brutal shakeout that hammered the price down near $87, this call seems absurd to many. But what if it's not just possible, but a mathematical inevitability? This isn't a speculative daydream. It's a forecast built on the collision of irrefutable industrial demand, a broken paper trading system, and geopolitical forces that are choking off supply. The analysts at major firms like Citi aren't just guessing. They are connecting dots that paint a picture of a market on the verge of a historic repricing. Let's break down exactly why the path to 150 is not a matter of if, but when. First, we must confront the terrifying reality of the physical market versus the paper illusion. The spot price on your screen says $87. But if you, as an individual or a factory manager, try to take delivery of a 1,000-ounce bar of silver today, you are not paying $87. You are paying a premium of nearly 50%, with prices for deliverable metal hitting $135 or more. This isn't a small gap. 'Tis a chasm, and it is the most important signal the market can give us. It tells us the quoted price is a fiction, sustained only by paper contracts in a system that is running out of the actual commodity. The COMEX, the world's key trading hub, is the epicenter of this crisis. Its latest data shows a staggering 6.5 paper claims for every single ounce of registered, deliverable silver in its vaults. This is not a stable ratio. It is a lit fuse. Projections for delivery demands in the coming weeks threaten to claim more silver than exists to be delivered. When the music stops, the paper price will be forced to surge to meet the physical reality. But why is the physical market so desperate? The answer lies in a fundamental shift that has turned silver from a monetary metal into an indispensable industrial component. The global green energy transition is not a future concept. It is happening now, and it is powered by silver. Solar panel manufacturing is consuming hundreds of millions of ounces annually, with year-over-year growth measured in double digits. Every electric vehicle battery requires significant amounts of silver in its conductive pastes. There is no commercially viable substitute. This is consumption on an industrial scale that simply did not exist a decade ago. Yet, on the supply side, the picture is bleak. Global mine supply has been stagnant for years. No major new mines are coming online before 2033 due to permitting and capital constraints. Recycling can only cover a fraction of the shortfall. The result is a persistent structural deficit measured in hundreds of millions of ounces of a deficit that grows larger every single year. Now, layer on the geopolitical shocks that are actively making this deficit worse. New tariff policies are violently disrupting traditional supply chains. Mexico, a top 3 global silver producer, is now diverting its output for domestic use as trade relations shift. Canadian byproduct flows are being constrained. Chinese export restrictions have already drained millions of ounces from the system. These are not temporary glitches. They are permanent reductions in the available supply for the global market. At the very moment industrial demand is hitting record highs, the taps are being systematically turned off. History provides a powerful guide here. Major silver bull markets are not smooth rides. They are punctuated by violent shakeouts that cleanse the market of weak hands before the next powerful leg higher. We saw it in 2011 with a deep retracement before a final surge. We saw it in the 1980 Hunt squeeze to current breakdown below $100 shares, all the hallmarks of these historic capitulation events. Extreme oversold conditions, panic selling volume, and a simultaneous quiet strength in the physical market where the real price is being set. Furthermore, the silver-to-gold ratio has blown out to over 100 to 1. Historically, such an extreme has been one of the most reliable buy signals for silver, almost always preceding a period where silver massively outperforms gold. So, what is the realistic path? The immediate floor is being established in the mid-$80 to low $90 range. This is the zone of maximum pain and final capitulation. From there, as the COMEX faces its delivery crisis and industrial buyers refuse to slow their consumption, the spot price will be forced to converge with the physical reality. A move to $118 could happen rapidly as the paper market acknowledges the shortage. From that new baseline, a relentless pressure of structural deficit and accelerating demand could propel prices toward the $150 target by year's end, with potential for even higher parabolic moves if the system experiences a full-scale failure of deliveries. Your strategy in this environment must be built on one principle: physical reality trumps paper promises. Your absolute priority must be to acquire physical silver in the most direct form possible. This means American Silver Eagles, Canadian Maple Leafs, or 1-ounce rounds from highly reputable dealers. You are not buying a ticker symbol. You are taking direct possession of the tangible asset that industry cannot function without. You must categorically avoid paper ETFs like SLV. These are financial instruments laden with counterparty risk, and they are bets on the very paper system that is demonstrating its fragility. In a true physical squeeze, holding an ETF receipt is not the same as holding the metal. Simultaneously, the mining sector offers leveraged exposure to the rising real price of silver. Companies like Hecla Mining and Core Mining, with substantial U.S.-based production, are no longer just equities. In an era of supply chain nationalism, they become strategic assets. Their fortunes are directly and powerfully tied to the price silver commands in the physical market. We are witnessing the great decoupling. On one side, a paper market of algorithms and leveraged bets, currently in a state of panic and manipulation. On the other, the physical world of industrial necessity, where the price is what you must pay to secure the material needed to build our future. The solar factory does not cancel its order because a hedge fund sells a paper contract. It pays the premium and ensures its production lines keep running. This industrial demand creates an unbreakable floor and an accelerating ceiling. The prediction of $150 silver is not a wild guess. It is the logical conclusion of simple math. Soaring demand plus stagnant supply plus fractured trade equals a price discovery event of historic proportions. The time for hesitation is over. The moment to align your portfolio with physical reality is now. Before the paper facade crumbles and the true price is revealed for all to see.